Hello, everybody. Welcome back to my Daily Dose with Tim. Today is season 2, episode 50. So we're only about 10 away now from finishing season 2. And today is part 3 of the case studies on an income property that we actually purchased a few years back. So really just leveraging this as an example. And a lot of it is exactly how it went down. And a lot of it is actually made up for the simple reason for demonstration's sake, really. And so today is part 3. We're going to quickly wrap this one up so that we can go into playing with some more fun factors, like how to really finance it. Because today, what I'm going to show you, and as we actually did during the last episodes, a couple of episodes as well, is to really just leverage ratehub.ca as a mortgage calculator to really figure out what some of the high level numbers are. And in real life scenarios, obviously, there's going to be some complication from time to time, and the numbers might not exactly go as how you budgeted, but that's just fine. And this is why a lot of the times when I train, and I think a lot of you have, if you've been following my Daily Dose with Tim for the last 2 seasons now, you know I always like to say, underestimate your revenues and overestimate your expenses as well. And so right now, we're using sort of middle ground numbers, in my opinion. It's not overly conservative. However, it's not also overly optimistic either, to be fair. So let's keep this thing going. And if you have been following all the way up till episode 49 already on this example, then you know we've actually gone pretty far already. So today, what we're going to do is figure out what our cash on cash return is. Okay, we're going to figure out what our cash on cash return is. So let me just quickly write that out right now. So cash on cash, it's very, very straightforward. And I've made a couple of videos already on the difference really between what cash on cash return versus return on investment really is. And I know some people really blend the two. To me, I don't want to, and I encourage you not to, so that it becomes very simple and yet very clear in terms of the kind of exit strategies you're applying. Because in this particular case, depending on how much money you get to pull out, obviously, if you get to pull out every last penny once you've gone through the stabilization period as a performance improvement period, meaning you can pull out maybe all of your initial investment, then your cash on cash is automatically infinite regardless. However, if not, then this is what we're going to be focusing on. So first thing first, cash on cash. Well, your cash really comes from the annualized cash flow number in this particular case and over your initial investment. Your annualized cash flow divided by your initial investment. So from the last episode, what we figured out is the annualized cash flow from this property is 12,321.92. And so initial investment is now something that we need to calculate. And so from the very first one, I still have my notes here with me. So if you want to refer back to, I believe this would have been episode 48 now at this point, is the fact that we had 25% down payment as our first expense. Well, in most calculations, that's probably your first expense because you do need to spend some money to get in there, just that it doesn't have to be your own cash, okay? So 25% on a $724,000 purchase. Let's just do it on the calculator, even though we can go back quickly to the RateHub calculator and grab that number right off the bat. This is just so that I don't have to switch back and forth on the screen right now with everybody. We'll go there as well. But for now, we're just going to do it this way. And then we said inspection in this particular case was 2,500. And then the next one is we have appraisal, okay, is also 2,500. And then we have miscellaneous fees, okay, and this is 3% of the purchase price. So 724, once again, 724,000 times 3%. So remember, because this is actually commercial lending. So what that really means is that you have broker fees, you have lenders fees, and you have other miscellaneous that will be tagged onto it. And this is also why whenever we do our analysis, we do an other fees as basically a buffer or a contingency, so that you can look to forecast different scenarios. And for a lot of the commercial units, especially bigger size, and this one is sort of, again, not big, not small. We said it's 14 units. So chances are environmental is needed, or land surveys would be needed as well. But we're going to pretend that we don't have this property and we're analyzing the deal. That's the purpose of this, okay? So we're going to say $5,000. And also, last but not least, we got to pay our lawyers to tie it up in a nice little bow on possession day for everybody, okay? So let's do that math and add everything up now. 181 plus 2,500 plus 2,500 plus 21,720 plus 5,000, and then 10,000. Okay, so now in total we have 222,720. And so what that means is we're going to insert this number over here. Going to keep it the same color so that it's a lot easier. And what we'll do now is this. So 12,321.92 divided by 222,720. And then, if you're a math geek, you want to do multiply by 100%. So what we will get now is, I'm going to use this color here, which is 5.53%. Okay, so this is 5.53% cash on cash. And so once again, if you've seen the other episodes, you understand that cash on cash, how you can really quickly interpret this is, how hard is your money working for you? Which also means, hey, you know what? If you put the same amount of money into, let's say, a bank account that's giving you some returns, this would be the interest rate that they would be giving you, 5.53, because that's the money that you're going to be able to take out in interest on a annual basis, or divided by 12 months, and you get it on a monthly basis. Except that in this particular case, remember, we use annualized number, but we do know that it was $1,026.83 in monthly cash flow. So again, it's funny to me sometimes still how quickly our perspectives can shift when we annualize a number, or when we convert it back to a monthly number, because $12,000 a year in terms of cash flow, to some of us, it's like, you know what, for $724,000, maybe I can do better somewhere else. Or when we look at 5.53% cash on cash, it's like, oh, that seems a little bit low, because a lot of us are aiming for, numbers higher than that. Everybody's a little different, especially depending on where you are on your journey as well, and also your risk tolerance level. And also, coming back here, the same old question, because we always say there are top two priorities along with the other ones when we invest in anything. It's just that in this particular case, we're talking about real estate investing. So what that means is we treat it as a business, which means number one priority, once again, cash flow. Number two, return on investment, or in this case, cash on cash return. And the reason why we focus on cash in this particular case is simply because of the fact that if you really want to do a full return on investment calculation, remember, you need to have a clear acquisition, cash flow period. Ooh, a little tongue-tied today. And then you have your clear exit. And in this case, exit, I don't mean buy, rent, and then hang on to it. We mean actually selling it, because that way you can calculate the entire return on your initial investment that has gone in there. So for example, if you decided not to do a refinance during the time that you're holding on to this property, and say 5 years later, you do want to sell it, so you can take the passive market appreciation and make that and factor in that calculation as well. Again, nobody's got a crystal ball. It's a pure guesstimate, which is why cash on cash return is such an important number for a lot of investors investing in income properties. However, that is something that you can do. And the other thing that you can factor in is also your mortgage pay down, provided that your mortgage repayment plan is principal and interest on a regular basis. If you only have interest payments, remember, don't factor that in. And so this is why a lot of the times, if you truly want to get the ROI, really from an annualized return perspective, you are adding annualized cash flow as well as your mortgage pay down. And last but not least, maybe your passive market appreciation rate that you are using for your calculation. That's when we get the ROI. However, at 5.53% at the moment, hey, if you're comparing to any sort of traditional vehicles like GICs in my American friends, that would be a CD for you, and that certificate of deposit. And for Canadians, again, traditional means it's your TFSAs, it's your RSPs, it's your regular savings account as well. So if you're comparing to all those traditional vehicles, 5.53% is amazing. And your money is secured against a piece of hard asset. And if you've done your calculations properly, that means you've already over budgeted for your expenses, which means the numbers should not be too much worse off unless you have some crazy catastrophe that could be happening either in the marketplace or with the building itself. However, that's due diligence now as we go through analyzing your deal in detail. So what that means is now we have 5.53, and let's just quickly go back and really review our overall key performance indicators right now. So we know the first thing that we got was our net operating income, which we got 41,805.92. If you need a recap, you can also go back to the last two episodes as well, because the numbers were all there. And so as a result, because once we got NOI and we knew our purchase price, we knew that the cap rate is 5.78. So not too shabby at all, okay? And then what we also have is the cost per unit was 51,714. Our rental yields, or our revenue yield, is actually 17.42%. That is the number that made it worth it to continue moving forward. And some of you guys, you might have heard it from other places, other sources as well, is something that we call the 1% rule, or the 12% annualized rule, if you will, which is if you take your purchase price and then you do a 1% on that, you should ideally be making that in monthly revenue. So that would be what most commonly refer to as the 1% rule, in case you've heard that, and I just want to put it out there as well. And so at this point, we got a cash flow of a bit over $1,000 on a monthly basis, cash on cash of 5.53, money secured against hard assets. To me, depending on where you are in your investment journey, to some of you, this could be a trash deal. To some of you, this could be a treasure deal. And so this is why we never go on to these sessions, at least for me and all of the Trust Your Talent coaches and trainers and mentors. We don't tell you, what's good, what's bad, because what's good for you might be what's good, a good deal for you might be a bad deal for somebody else, and vice versa. It's all about what your financial goal is and what you need to focus on, both in the short term and the long term. And so a lot of students always ask me, oh my God, you know what? It's really, really difficult to find deals that satisfy both criteria. Then my answer has always been, remember, time is the most important thing. Time is everything. Time is not just money. Time is everything. And so what is the first goal you want to hit? Is it to become financially independent or financially free? If it's to become financially free, then what that means is you want to focus on passive income as much as you possibly can. And so for me personally, that was the decision that I made, because I wanted to be able to rely on my passive income solely so that I can earn my time back. Once I did that, when I started to evaluate other deals after that, I'm okay with the cash flow not being great, but much better return on investment or much better cash on cash overall as well. So treat it as a process. It's not a be all and all situation here. Okay. So this is really the core of everything that we are doing on the case studies when it comes to really looking at the KPIs. So for the next few episodes, we're going to go into being a little bit more analytical and also a little creative as well in terms of how we can fund this deal. In my opinion, there's never really any tips or tricks. It's just how you think and how we make it happen. Remember, when it comes to an income property, the most important number to me is the NOI, because the asset needs to be performing, or at the very least has the potential to be performing better before we even look at any other indications, because that in itself signifies whether or not this is a viable business. And so for some of you who just want to double check on how we got all the numbers and how we got there, here is, I believe this is the tab, the Rate Hub page. Once again, ratehub.ca for my Canadian friends. Everywhere else, please use a regular mortgage calculator from your country, because the way Canadian banks or lenders charge us, we end up paying just a little bit more. Okay, I've explained that in the other episodes before too. And so at $724,000 as purchase price, remember 25% down payment, that worked out to be 181,000, same number as the one that we got from the calculator as well. And so when we punch in 25 years in amortization and a mortgage rate of 2.59%, we got a total mortgage payment of $24.57 on a monthly basis. Once again, I just want to let you know that typically speaking, we use Rate Hub as our baseline. And this is basically your way of building in some high level numbers for yourself. When it comes to commercial lending, you really want to make sure that you include your mortgage broker from day one. Obviously, from day one, I don't mean it as in, hey, you know what, Mr. Mortgage Broker or Miss Mortgage Broker, I came across a listing because my realtor sent me a listing or my wholesaler sent me a listing, and here you go, tell me what you think. Not about that. Okay, the first three parts of the case studies is to show you how you can run your own high level numbers first, so you can determine whether or not it's something that's worth pursuing. And then you engage your mortgage brokers. And in this case, you can even give them a range. Okay, again, we're not rate shopping. I want to make it very clear. However, ask them, hey, you know what? I got a 14-unit property potentially coming up that I want to get under contract, and it's located in this market. The cap rate from CMHC says this in that market, and this is the high-level KPIs right now. What do you think is fair? Okay, and you can even let them know, I've already run some analysis on my own, so I can do 1.8%. Okay, remember, this is how you change it. Get rate, right? 1.8% brings it down to 2247. Or you can say, hey, I've stress tested this. Oops, sorry. Select rate. Or you can say, I'm going to do 3.5 here. It brings it up to 2711 on a monthly basis in terms of mortgage payment. And you can stress test it yourself. You can bring it up even further. However, you know, as long as you got the other criteria that hit your requirements, meaning your cash flow as well as your cash on cash, and then you still want to pursue, if your mortgage broker comes back and said, hey, you know what, for something like this, the best I can do right now without submitting further documentations and supporting documents, we're looking at 3.8 period, then this is where you can make that quick decision without burning up and wasting your own time and go, okay, you know what, it's decent, but it's not gonna hit my numbers, so I'm gonna move on. However, some of you might go, ooh, hang on a second. If it's only cash flowing, let's say $800 a month and not $1,000 a month, but I might have somebody in my database, I can wholesale it out now. That might be another way you can do this too, okay? So this is how we start to tie everything together. It's the thought process that counts. And this is what a lot of the times the mentoring is about. The training really teaches you how to analyze, how to acquire, how to do your due diligence. and do your market research. However, really, the mentoring part is to tailor that individual thought process one-on-one with you. Because once again, we're not all born equally, we're not all trained equally, and we also have different life experiences and skill levels and risk tolerance, more importantly. And so this is not a one-size-fits-all situation. Okay, so with that said, I'm going to quickly show you the board just so that you can take a picture if you want to for yourself. And then we're going to conclude episode 50 here. So with that said, thank you so very much for joining me. And for those of you who have been inquiring about episode 50, I appreciate you and I thank you for following so diligently. There have been a few things that are happening in life at the moment. And so I will do my best to finish the 60 episodes as promised over the next little while with everybody. And I will be back here, like I said, with part 4, part 5. We're going to get a little bit more analytical and we're going to get a little bit more creative with the financing part as well. That's really where the fun part starts for a lot of us. So with that said, thank you for your comments. Thank you for liking and especially sharing the videos. Keep sharing, because I understand now at this point, so many of you have been saying that the messages and what I'm looking to accomplish with these videos, you can really relate to it. So I appreciate you for that. And I thank you, forever grateful for your generosity and for your shares. So with that said, I will see you back here at the next episode. Thank you again and live well, everybody.